Hello, welcome to Capital Sensei. Today we're going to dive deep into one of the most important books ever written about investing, Security Analysis by Benjamin Graham and David Dodd. We'll explore its foundational principles, like the crucial difference between investing and speculating, the art of finding a company's true intrinsic value, and the single most powerful concept for protecting your capital: the margin of safety. This is the blueprint that shaped investors like Warren Buffett. Whenever we can, we try to answer questions left in the comments. The world of finance can feel complicated, and sharing experiences makes it easier for everyone. So please, feel free to comment with your doubts, your stories, or your own insights. It really helps build a community where we can all learn from each other. All right, let's get into it. To truly understand security analysis, you have to know when it was written. Benjamin Graham and David Dodd published the first edition in 1934. Think about that for a moment. The world was still reeling from the Great Crash of 1929 and the Great Depression that followed. This wasn't a book written during a time of irrational exuberance. It was forged in the fires of financial devastation. This context is everything. It explains why the book is so focused on risk, preservation of capital, and a disciplined, almost scientific approach to the market. Graham had seen people lose everything by treating the stock market like a casino. So the very first thing he does is draw a hard, bright line in the sand between two very different activities: investing and speculating. This distinction is the bedrock of his entire philosophy. For Graham, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Anything that doesn't meet all three of those criteria, thorough analysis, safety of principal, and an adequate return, is by definition speculation. Let's break that down. Thorough analysis means doing your homework. It means digging into the financial statements, understanding the business model, and assessing its long-term prospects. It's not about guessing which way a stock chart will wiggle tomorrow. It's about understanding the business you are considering buying a piece of. It's the difference between buying a farm because you've studied the soil quality and rainfall patterns, versus buying it because you heard a rumor that a highway might be built nearby someday. Safety of principle is the idea that your first job as an investor is not to lose money. This might sound obvious, but in the heat of a bull market, it's often the first thing people forget. Graham believed that if you focus on not losing, the winning tends to take care of itself. We'll talk more about how he achieves this in a bit, but it's a mindset shift. You're a risk manager first and a profit seeker second. And finally, an adequate return. Notice he doesn't say a spectacular or guaranteed return. Adequate is a humble, realistic word. It means a return that is reasonable for the risk you are taking. For some investments, that might be a modest but very safe 5%. For others, it might be a potentially higher but still carefully vetted 10 or 12%. The key is that the return is justified by your analysis, not just by wishful thinking. So, if you buy a stock simply because your friend told you it's going to the moon, you're speculating. If you buy a cryptocurrency because its price has been going up fast, you're speculating. If you're buying without having done the hard work of analysis to confirm the safety of your initial capital, you are not investing, according to Graham. You are rolling the dice. There's nothing inherently immoral about speculating, but you must never, ever confuse it with investing. Know which game you're playing. This leads us directly to the next monumental concept: intrinsic value. If you're going to do a thorough analysis, what are you analyzing for? You're trying to determine a company's intrinsic value. This is the real underlying value of a business, based on its assets, its earnings power, and its future prospects. It's a value that is completely separate from its fluctuating day-to-day stock price. The stock price is what you pay. The intrinsic value is what you get. Imagine you're thinking about buying a local coffee shop. The owner is asking for $100,000. Is that a good price? How would you decide? You wouldn't just look at the asking price. You'd look at the business itself. You'd count the tables and chairs, check the condition of the espresso machine. Those are its assets. You'd ask to see the books to find out how much profit it makes each month. That's its earnings power. You'd consider its location and loyal customer base. Those are its prospects. After doing all that homework, you might conclude that, as a functioning business, the coffee shop is reasonably worth about $120,000. That $120,000 is your estimate of its intrinsic value. The $100,000 asking price is its market price. In this case, the market price is below the intrinsic value. That's an interesting situation. Now, what if you concluded the business was only worth $80,000? Then the asking price is too high. This is exactly what Graham did, but with publicly traded companies. He looked at them not as ticker symbols on a screen, but as actual businesses. He was a business analyst, not a market timer. Calculating a precise intrinsic value is part science, part art. There's no single magic formula that spits out a perfect number. It's an educated estimate. But the process of trying to find it forces you to think like a business owner, which is the entire point. Now we get to the heart of the whole system, the concept that ties everything together and provides that safety of principle. This is the margin of safety. It is, without a doubt, the most important single concept in security analysis. The margin of safety is the discount between the intrinsic value of a company and the price you actually pay for its stock. It's your cushion, your buffer, your protection against the unexpected. Let's go back to our coffee shop. You calculated its intrinsic value to be $120,000. The owner is asking $100,000. Should you buy it? According to Graham, probably not. Yes, there's a $20,000 gap. But what if your analysis was a bit too optimistic? What if a new competitor opens across the street next year? What if the price of coffee beans skyrockets? Your small advantage could evaporate quickly. But what if you could buy that $120,000 business for just $70,000? Now you have a $50,000 margin of safety. That's a huge cushion. Even if you were wrong in your calculations, even if the business faces some headwinds, you've bought it so cheaply that you have a very high probability of not losing money and a good chance of making a handsome profit when the market eventually recognizes the business's true worth. Think of it like building a bridge. If engineering calculations show the bridge needs to support a maximum load of 10 tons, you don't build it to hold exactly 10 tons. That would be insane. You build it to hold 15 or even 20 tons. That extra 5 or 10 tons of capacity is the margin of safety. It protects you against calculation errors, material defects, or future conditions you couldn't have predicted. Investing without a margin of safety is like driving a car with no brakes, hoping you won't need to stop suddenly. So the whole process flows together. First, you commit to being an investor, not a speculator. Second, you conduct a thorough analysis to estimate a business's intrinsic value. Third, you patiently wait until the market offers you a chance to buy that business at a price that gives you a significant margin of safety. If you can't find any such opportunities, you do nothing. Patience is a critical virtue for the value investor. So how did Graham actually perform this analysis? He was a numbers guy, through and through. He trusted tangible facts and figures far more than he trusted rosy predictions about the future. He spent most of his time poring over a company's financial statements, particularly the balance sheet and the income statement. This is the quantitative part of the analysis. The balance sheet was especially important to him. It's a snapshot in time of what a company owns, its assets, and what it owes, its liabilities. Graham loved to find companies whose assets were being deeply undervalued by the market. His most famous technique here was looking for what he called net nets. This is an extreme form of bargain hunting, and it's a bit harder to find these days. But the principle is brilliant. A net stock is a company whose stock price is trading for less than its net current asset value. Let's make that simple. You take a company's current assets, things like cash, accounts receivable, and inventory, and you subtract all of its liabilities, both short-term and long-term. Everything it owes. The number you're left with is the company's net working capital. Graham looked for situations where he could buy the entire company's stock for less than this number. This is like finding a wallet on the street. Inside the wallet is $100 in cash. You also notice there are some IOUs in the wallet, let's say for $20. So the net cash in the wallet is $80. Graham looked for a situation where he could buy that entire wallet, including the $80 of net cash, for a price of, say, $50. It's an absurdly good deal. You're getting the cash for a discount, and you're getting the business itself, the factory, the brand, everything, for free. These were the ultimate margin of safety plays. The business could literally shut down, sell off its current assets, pay all its debts, and the shareholders would still get back more cash than they paid for their stock. This illustrates how deeply Graham was focused on asset protection. He wasn't just buying earnings, he was buying a pile of assets at a deep discount. Of course, he also analyzed the income statement, which shows a company's profitability over time. He wanted to see a long history of stable, consistent earnings. He wasn't interested in flashy, fast-growing companies with no track record. He preferred the boring, predictable businesses. He had specific rules of thumb, like an earnings-to-price ratio, the inverse of the PE ratio, that should be competitive with bond yields. He also wanted to see that earnings were high enough to comfortably cover any debt payments several times over. This points to another key aspect of security analysis. It's not just about common stocks. A huge portion of the book is dedicated to analyzing senior securities, like bonds and preferred stocks. Remember, this was written when capital preservation was paramount. For Graham, buying a bond was about one thing and one thing only: absolute certainty of getting your interest payments and your principal back. When you buy a bond, you're a lender, not an owner. So, you have to think like a very cautious banker. Graham set out strict quantitative tests. For a public utility bond, for example, he might demand that the company's earnings over the past 7 years have, on average, been enough to cover its total interest charges at least twice over. For an industrial bond, where business is more cyclical, he might demand a coverage ratio of 3 or even 4 times. He was building a fortress around his capital. This methodical, almost clinical approach is a world away from the emotional roller coaster that most people experience in the market. And Graham had the perfect allegory to explain how an investor should think about market fluctuations. The story of Mr. Market. This is probably his most famous and enduring contribution to financial literature. And it's a lesson in behavioral psychology. He asks you to imagine that you are a part owner in a private business. You have a partner named Mr. Market. Market. The problem is, Mr. Market is a bit of a lunatic. He's a manic depressive. Every single day, he comes to you and tells you what he thinks your shares are worth. And he offers to either buy you out or sell you his shares at that price. Some days, Mr. Market is euphoric. He sees nothing but a rosy future for the business, and he quotes a ridiculously high price for your shares. On other days, he is utterly despondent. He's convinced the business and the world are going to hell in a handbasket, and he offers to sell you his shares for a pathetically low price. Now, a foolish person would let Mr. Market's mood swings dictate their own. When Mr. Market is excited, they get excited and buy at high prices. When Mr. Market is terrified, they get terrified and sell in a panic at low prices. But the intelligent investor does the opposite. You have the right to completely ignore him. His daily quotes are there to serve you, not to guide you. You should be happy to sell to him when he's in a state of wild optimism and quotes an absurdly high price. And you should be even happier to buy from him when he's in the depths of despair and offers you a bargain. The point is, you, the investor, are the one with the stable footing because you've done your homework and you know the business's intrinsic value. Mr. Market's moods are an opportunity, not a threat. Yeah, you use his foolishness. You don't participate in it. This allegory perfectly captures the essence of value investing. It teaches you to divorce your financial decisions from the noise and emotion of the market. The market is there to provide you with prices, and occasionally, those prices will be foolish. When they are foolishly low, you buy. When they are foolishly high, you sell. The rest of the time, you tend to your garden. You read a book. You do nothing. Graham understood that not everyone has the time, skill, or temperament to be this kind of active, analytical investor. So, in his later work, he refined his ideas and defined two distinct paths for two types of investors: the defensive investor and the enterprising investor. This is a really practical and helpful framework. The defensive investor is someone whose primary goal is safety and freedom from worry and effort. This person doesn't want to spend their weekends reading balance sheets. For this type of investor, Graham recommended a simple, disciplined approach. This would involve holding a balanced portfolio, perhaps 50% in high-grade bonds and 50% in stocks. For the stock portion, the defensive investor shouldn't try to be a hero. They should buy shares in large, prominent, and conservatively financed companies. Think of the biggest, most stable blue-chip companies. And even then, they should only buy when the price is reasonable, perhaps not trading at more than 25 times average earnings over the past 7 years. They should also seek out a long, uninterrupted history of dividend payments. And, crucially, they should diversify across at least 10 to 30 of these names. It's a strategy designed to be safe and simple. The enterprising investor, on the other hand, is what security analysis is really written for. This is the active, engaged person who is willing to put in the time and intellectual effort to find exceptional value. The enterprising investor goes beyond the simple rules for the defensive portfolio. They are the ones hunting for the nets we talked about. They might also look at so-called special situations or workouts. These are things like mergers, liquidations, or reorganizations where the profit depends on a specific corporate action, not on the general direction of the market. These require a lot of specialized knowledge, but they are another way to divorce your results from the whims of Mr. Market. The enterprising investor is, in short, a professional, or at least a very serious amateur, playing the game at a high level. It's really important to be honest with yourself about which category you fall into. Trying to be an enterprising investor without the requisite time, skill, and emotional discipline is a recipe for disaster. For most people, a defensive strategy is far more appropriate and will likely lead to better long-term results. Graham was a pragmatist. He gave people tools that fit their own capabilities. Now you might be thinking, this all sounds great, but the book was written almost a century ago. Does any of this still apply in today's world of high-speed trading, complex derivatives, and the internet? And the answer is an emphatic yes. The principles are more relevant than ever. The tools and the speed of information have changed, but the fundamental nature of business and human psychology have not. Businesses still have assets and earnings. They still have value that is independent of their stock price. And most importantly, people are still driven by fear and greed. Mr. Market is alive and well, and his mood swings are as wild as ever, perhaps even more so with the 24-hour news cycle and social media amplifying every bit of news. The core message that a stock is a piece of a business and that you should buy it for less than it's worth is timeless. Of course, the application of the principles has evolved. Graham's most famous student, Warren Buffett, started out as a strict Graham-style cigar butt investor, looking for those nets. Discarded cigar butts on the street that had one free puff left in them. They were cheap, ugly, and good for a small, quick profit. But over time, influenced by his partner Charlie Munger, Buffett shifted his focus. Instead of buying fair companies at wonderful prices, he began to focus on buying wonderful companies at fair prices. This meant paying more attention to the qualitative aspects of a business: the strength of its brand, the quality of its management, its competitive advantages or moats, things Graham was more skeptical of because they were harder to quantify. Even so, the DNA of this approach is pure Graham. Buffett is still estimating intrinsic value, and he is still demanding a margin of safety. He just broadened the definition of value to include the immense worth of a dominant, durable business. He's applying the same fundamental operating system, just with an updated software package that accounts for the value of intangible assets. So when you strip it all down, what's the big takeaway from this dense, intimidating book? It's that investing successfully doesn't require a stratospheric IQ or inside information. What it requires is a proper intellectual framework for making decisions and the ability to keep your emotions from corroding that framework. Security analysis provides that framework. It teaches you to be a business person, not a gambler. It forces you to be disciplined, to base your decisions on fact and analysis, not on hope and speculation. It teaches you that risk is not about the volatility of a stock price, but about the possibility of a permanent loss of capital. And the best way to avoid that is to always insist on a margin of safety. Reading security analysis isn't easy. It's a textbook, not a novel. It's detailed, it's technical, and it can be dry. But the core ideas within it are like a lighthouse in the fog of financial markets. They are simple, powerful, and they can guide you safely to shore while other ships are crashing on the rocks of speculation and emotion. It's not a path to get rich quick. It's a proven philosophy for getting rich slowly and, more importantly, staying rich. By focusing on what a business is worth and paying a lot less for it, you stack the odds firmly in your favor. And in the long run, that's the only game worth playing.